You may have seen headlines like this: "Be ready for a stock market crash in 2026. And there's a reason people are starting to worry. After years of rapid growth and record valuations, many analysts believe the market is now dangerously overextended. As US stock indexes chug ever higher, more market watchers are starting to worry. For example, the chair of the Federal Reserve, Jerome Powell, recently said that share prices are fairly highly valued. You can say that again. The S&P 500 rose 3.5% last month, the index's strongest September in about 15 years. And its price-to-earnings ratio now sits around 30. By historical standards, that's very high. When markets soar and headlines scream record highs, something strange happens. People begin to believe the rules have changed. They say stocks have reached a permanently high plateau. They insist house prices never fall. And someone inevitably declares this time is different. But history says otherwise. Every time we think we've escaped the cycle of boom and bust, reality reminds us we haven't. From the Dutch tulip mania of the 1600s to the dot-com frenzy of the late 1990s, and from the US housing bubble of 2006 to the cryptomania of recent years, the same human story repeats. Greed, euphoria, and overconfidence build up quietly until the crash exposes just how fragile it all was. Today, as markets once again reach dizzying heights, the warning signs are flashing. Are the headlines saying, "Be ready for a stock market crash in 2026" actually right? Is a crash really coming? In this video, we're going to look at what happens before a market crash and examine whether we're seeing those same patterns unfold right now. Every crash begins not with numbers, but with emotion. Human psychology is the fuel that powers every speculative bubble. People don't invest rationally when things are booming. They invest emotionally. Economists call it herd behavior. When everyone around you seems to be getting rich, it feels almost irrational not to join in. Even the most cautious investor starts to think, if they're making that kind of money, maybe I should too. It happened during the South Sea bubble in the 1700s. Even Sir Isaac Newton, yes, the same Newton who discovered gravity, yes, the 18th century genius who invented calculus, formulated the laws of motion, made groundbreaking contributions in physics, mathematics, astronomy, and optics, and transformed modern science, was swept up in the frenzy. He was one of the most intelligent men to ever live, a genius whose discoveries reshaped the world. And yet, even he couldn't resist the emotional pull of herd behavior. At first, Newton invested early and wisely, selling his shares for a profit. But when he watched others around him making even greater fortunes, he gave in to the same temptation that grips millions of investors in every age: fear of missing out. He walked back in near the top and lost £20,000 in the market panic. That's more than £3 million, or roughly $4 million in today's money. Afterwards, he famously lamented, "I can calculate the motions of the heavenly bodies, but not the madness of men." His story is a timeless reminder that herd mentality can blind even the sharpest minds. If a man who unlocked the secrets of gravity could be swept away by greed and emotion, what makes us think we're immune? Intelligence alone cannot protect us from the powerful emotions that move markets, especially when greed and fear grip the crowd. The danger isn't the technology itself. AI is transformative. The danger is when investors forget that no technology, no matter how powerful, can escape basic economic reality. The Buffett indicator, a classic warning sign. Legendary investor Warren Buffett once pointed to one metric as a single best gauge of whether the stock market is overvalued: the ratio of total market capitalization to GDP. In simple terms, It compares the total value of all publicly traded companies to the size of the entire economy. Buffett said that when the ratio is around 70%, markets are likely cheap. When it nears to 100%, it's flashing red. As of late 2025, that ratio is hovering around 220%, one of the highest levels in modern history, surpassing even the peaks of 1999 and 2007. It doesn't mean a crash will happen tomorrow, but it means valuations have become dangerously stretched. The stock market is now worth more than twice the size of the economy that supports it. And history shows what usually follows such extremes: a painful correction. It's worth remembering, markets don't collapse when everyone is fearful. They collapse when everyone is euphoric. Right now, that euphoria can be seen in the numbers. Since the April 2025 tariff shock, US stock prices have surged more than 20%, despite rising inflation fears, high interest rates, and warnings of slowing global growth. The message from Wall Street seems to be, crash? What crash? But that complacency is exactly what makes economists uneasy. The truth is, investors are treating risk like it no longer exists. Corporate profits are growing slower than valuations, yet prices keep climbing. Much of the optimism is pinned on artificial intelligence boosting productivity and profits. But that's precisely what people said about the internet in 1999, until reality caught up. Back then, the internet was hailed as a force that would completely redefine business, communication, and wealth itself. Investors poured billions into dot-com startups, many of which had no profits, no real business model, and sometimes not even a product. Stock prices soared purely on hype, as if the old rules of economics had been rewritten. When the bubble finally burst in 2000, trillions of dollars in market value vanished almost overnight. Giants like Pets.com and Webvan became cautionary tales, and even tech titans like Amazon saw their share prices collapse by more than 90% before recovering years later. Meanwhile, gold has hit record highs, a traditional signal of fear and uncertainty. The US dollar has weakened sharply, down nearly 10% this year, and government bond markets have grown volatile. These are classic symptoms of stress building beneath the surface. Gold usually rises when investors lose confidence in paper assets or worry about inflation. In other words, when gold and stocks rise together, something is out of balance. It suggests money is chasing safety and speculation at the same time, a contradiction that rarely lasts long. Another thing that always happens before a crash is debt expansion. Booms are built on borrowed money. When people or governments borrow heavily to chase growth, they create a fragile system that can only survive as long as confidence remains. In 2008, it was the reckless expansion of mortgage lending, subprime loans handed to borrowers who couldn't afford them, that set off the collapse. Financial engineers created complex instruments called CDOs and credit default swaps that few understood, but everyone wanted. They turned risky mortgages into supposedly safe assets, and when the illusion cracked, the entire global system shook. Today, the debt picture looks different, but no less concerning. Household debt in the US is more stable thanks to 30-year fixed mortgages, but government debt has exploded. Across the developed world, deficits are ballooning as aging populations demand more spending and productivity growth slows. Governments that borrow in their own currency are harder to topple, but not invincible. As debt piles up, interest payments grow. Eventually, investors demand higher yields to compensate for risk, and that can trigger a new kind of crisis, one rooted in confidence, not credit. Another warning sign flashing today is stagflation, a mix of rising prices and slowing growth. Inflation has started creeping up again in late 2025, driven by higher food costs and tariffs feeding through global supply chains. At the same time, economic indicators show growth slowing across Europe, Asia, and North America. This is eerily similar to the 1970s, when oil shocks and trade disruptions sent prices soaring even as economies stagnated. Policymakers today are trying to avoid repeating that era, but their tools are limited. Cut interest rates and you risk more inflation. Keep them high and you risk recession. It's a trap with no easy exit, and markets don't like uncertainty. There's no doubt that AI is transforming industries. From chip makers to software giants, profits have surged on the promise that artificial intelligence will redefine productivity. But history reminds us that new technology is often overhyped before it delivers. In the 1990s, the internet truly did change the world, but it took years before the profits matched the valuations. Many dot-com companies disappeared before the survivors, like Amazon and Google, rose to dominance. The same pattern could repeat with AI. It might change everything, but not before investors learn some painful lessons along the way. The phrase, "this time is different," might be the most dangerous in finance, because it never really is. Another recurring theme before every crash is regulatory complacency. After each crisis, governments promise to tighten oversight. But as time passes and memories fade, pressure builds to roll back the rules. After 2008, regulators imposed stricter capital requirements and lending standards on banks. But in recent years, some of those safeguards have quietly been relaxed. Meanwhile, new forms of financial risk have emerged outside traditional banking. Crypto exchanges, unregulated lending platforms, and complex derivatives traded online by retail investors. History suggests that crises rarely repeat in the same way. Instead, they exploit new vulnerabilities. The 2008 crash was about mortgages. The next one could easily come from somewhere regulators aren't looking. When prices rise, more people want to join in. Psychologists call it FOMO, the fear of missing out. In markets, FOMO is dangerous because it turns rational investors into gamblers. The faster prices rise, the stronger the urge to buy, even when logic says stop. This effect has driven everything from the Bitcoin frenzy to the meme stock mania of 2021. Prices were no longer determined by fundamentals, but by internet memes and collective excitement. And just like tulip bulbs in the 1600s, once the excitement fades, the crash follows fast. Even one of history's greatest scientific minds, Sir Isaac Newton, fell victim to it. During the South Sea bubble of 1720, Newton made a fortune early but watched friends make even more. He couldn't resist jumping back in, only to lose everything when the bubble burst. Later, he reportedly said, "I can calculate the motions of the heavenly bodies, but not the madness of men." That madness sadly never goes away. So what about now? Do we see the same warning lights that have flashed before every major crash? Many economists would say yes. Let's list them. Overvalued markets. Price-to-earnings ratios are near record highs. Debt growth. Government debt is at multi-decade peaks. Speculative enthusiasm. AI-related stocks dominate market gains. Regulatory loosening. Some post-2008 financial safeguards are being rolled back. Global uncertainty. Geopolitical tensions, tariffs, and slowing growth loom large. Each factor alone might not cause a crash, but together they create the perfect storm. Then there are the things no one can predict. Economists call them black swan events, rare, unexpected shocks that change everything. A geopolitical conflict, a sudden surge in oil prices, or a major cyber attack could all destabilize markets overnight. We can't foresee them, but we can prepare for them by recognizing how fragile the system has become. When everything depends on optimism, it doesn't take much to trigger panic. One of the most important lessons in finance is that the stock market is not the economy. It reflects expectations, not current reality. Markets can soar even when ordinary people are struggling, and they can crash even when the economy looks fine. That's why timing a crash is so difficult. In fact, before every major correction, there are usually years of predictions that don't come true. Eventually, one does, but by then, few are listening. Long-term investors know this. If you hold quality assets for years or decades, you'll likely recover from even severe downturns. But that doesn't mean we should ignore warning signs. Awareness is what separates wisdom from wishful thinking. What we're seeing today is not just about markets. It's about the world entering a new phase. Aging populations, rising debt, slowing productivity, and technological disruption. These long-term shifts mean we're operating in uncharted territory. AI might boost efficiency, or it might displace jobs faster than economies can adapt. Governments might manage their debts responsibly, or they might choose inflation as the easiest way out. The point is, uncertainty is rising, and that's when markets are most fragile. So, what always happens before a crash? It's never just one thing, it's a pattern. Asset prices become detached from reality. Debt expands beyond control. New technologies fuel speculative euphoria. Regulators look the other way. Investors convince themselves that the old rules no longer apply. Then, one shock, sometimes small, sometimes global, pulls the thread that unravels it all. So, what do you think? Is a crash on the way? Share your thoughts in the comments below. Like, comment, and subscribe for more.